Hey, what's up, everybody? Hope you're doing well. If you don't know what a bond is, stick around because I'm going to break it down. I'm going to keep it super simple. And in about 5 minutes, you're going to know exactly what a bond is. So let's get into it. So a bond is a loan. And usually the people issuing the bond or the people needing the money is a corporation or a government entity. And the government can either be a local, state, or a federal government. A bond is essentially an IOU with some interest, and they're also known as securities. So I came up with this very simple explanation or very simple example, and it's a 1-year bond with a 2.5% yield. And I'll explain what that means in a second. So this guy over here needs $100. He's all out of cash. His pockets are empty. He needs to do something. You know, if he's a corporation, he needs to, fund some research and development, or if he's a government, he needs to fund some government program. Whatever he needs to do, he needs $100, and he needs it right now. So goes into the market, finds this guy sitting on a big old pile of cash, and says, "Hey, I need one of those $100 bills. You got a lot of them. Let me borrow one." And so this guy says, "All right, I'll let you borrow one, but I'm not going to do it for free." And he says, "All right, fair enough. I'll give you a 2.5% yield or a 2.5% interest on your $100 for 1 year." And this guy says, "All right, fair enough." So what happens is this guy over here issues the bond. The bond owner gives him, this guy becomes the bond owner once he gives this guy over here the $100. Once that happens on day one, everybody's happy. He now has the $100, and this guy over here holds the bond. The interest payments on bonds are paid every 6 months. And so this 2.5% yield on $100 is $2.50. So 6 months in on a 1-year loan, he owes this guy $1.25. So 6 months in, the borrower pays the bond owner $1.25. 6 months after that, a year after he received the $100, at the maturity date when he owes all of the money back, he then gives the $100 plus the $1.20, the additional $1.25 interest back to the bond owner, and the bond owner who gave the $100 now has the original $1.25 interest plus the additional plus his principal. So now he has $102.50, and that is generally, basically, how a bond works. So why do governments and corporations issue bonds? Pretty simple: to fund programs. Governments, they need to fund roads, schools, Social Security, whatever they need to do. The most common one, wars, not most common, but the most well-known one are war bonds. And so, a relevant one right now is, say, we had to go to war with Russia, then the US could issue war bonds and fund the war. Corporations do it for lots of reasons. Some examples are property, plant, and equipment. Property is land, plant is buildings, equipment is, tractors or whatever, use your imagination. Pharmaceutical companies could, fund research and development on new drugs. You can use to hire employees, whatever you want. Now, bond prices change. They don't stay consistent. If you buy a bond, your price is not going to change. But say you want to get rid of your bond into the market, right? Bond prices change. What governments and corporations charge, what they can sell bonds for, change because markets are constantly changing. So bond prices, just like stock prices, have to change. And so in a good economy, and the number one thing you have to take away is bond prices and yield or interest rates are inverted. They are inversely correlated. So when bond prices go down, interest rates go up. When bond prices go up, interest rates fall. And the reason why is because in a good economy, bonds are, well, quick side note, bonds are seen as safe haven assets. So they're very safe. And when you're not taking a lot of risk, you're not going to get a lot of money back, on your investment. The reason that you get a lot of money back on your investment, it doesn't matter if it's bonds or stocks or whatever it is, if you take a lot of risk, you have the potential of getting a huge reward. You might also lose a lot of your money, but you can make a lot of money. So in a good economy, when everything's going up, a lot of people want to invest in the stock market because they want to make maximum return on their investment. They want to make as much money as possible. And bonds, which are seen as safe haven assets, generally don't give the loaner, the person investing, as much return on their investment. So corporations and governments have to attract buyers. right? If a lot of people want to make more money on the stock market and they don't really want to buy bonds, how do you attract those people to come and buy your bonds? Well, you lower the bond price and you raise interest rates. So we're going to lower the price and we're going to pay you more at the end, all throughout the way. We're going to pay you more interest and lower the price. And so that attracts more buyers. And they say, all right, well, I'll do it now because that makes more sense. But when you're going through a recession, everything's crumbling, then everybody starts panicking and say, okay, I need a safe place to put my money. And the reason bonds are so safe, especially government bonds, is because they're backed by the federal government. And so since they're backed by the federal government, and generally speaking, the government is not going to default on its loans. That's a whole other video. I'm definitely going to get into that eventually. But generally speaking, for this video, the government is not going to default on its loans. So that is a very safe place to park your money. Even though it's not going to make you a lot of interest, when everything's crashing, you want a safe place to park your money. And so when the demand is high, corporations and governments raise the bond price and lower the interest. They say, we're going to charge you more and we're not going to pay you as much interest because we have so many people wanting to buy this bond. Right. So when confidence markets feel good about taking more risk, they get out of bonds and bond prices fall, yield interest goes up. And when people start getting worried and they start seeking a safe haven asset, then bond prices go up, yield interests go down. And that's the way the bond price works. The downside to bonds, the number one threat to a bond is inflation. So say you bought a 10-year bond, a year ago, the current 10-year yield. So this is what a 10-year bond generally will pay you right now. I just looked this up. It's called the 10-year yield. You can look it up on any finance. You go to Yahoo Finance and just look at the 10-year yield. They have like the Dow, the S&P, the NASDAQ, the Russell 200, Russell 2000. And then there'll be like the 10-year yield. So that's what it is right now, 2.32. But say, I don't know exactly what it is 2 years ago, but say you bought it for 2.5%, or say you bought it for 2.32%. Now inflation's 7.9%, and you're losing 5.58% on your investment. You're making 2.32% per year, but the inflation is eating away at your principal. So you're losing 5.5% per year. So your principal, the amount you invested, is losing money. The other issue or a thing you have to worry about when investing in bonds, like I was saying before, is that if a great example is at the beginning of 2020, when everything started to crash, people started to panic. That's when everybody would, normally rush into bonds. And that's, what happened. Interest rates started to rise. And, but if you had taken the other side of that trade, which a lot of people ended up doing eventually, you could have made a lot more money, right? So you can go into the safe haven of bonds, but you're giving up the opportunity to make more money in the stock market. So if there's not a whole lot of risk, if you want to park your money in a safe haven, but there's not a whole lot of risk in the market, you're giving up the opportunity to make more money elsewhere. And that's called an opportunity cost. And a couple important definitions about bonds. When governments issue bonds, they're either called treasury bills, notes, or bonds. And treasury bills mature under 2 years. Treasury notes mature between 2 and 10 years, and treasury bonds mature between 10 and 30 years. Now, all three of these are under the umbrella of treasury securities. So if someone says, oh, I got a security, I bought a security the other day, first question would be, okay, is it a corporate security or a government security? And then the second question, if they said government, was, okay, did you get a bill, a note, or a bond? And that would give you a good understanding of whether or not they made a short-term investment, a medium-term investment, or a long-term investment. Additional thing, which is important to point out, is government bonds generally offer a lower yield or a lower interest rate because since they're backed by the government, they're considered very, very safe. And since they're very safe, like I was saying before, if you're not taking more risk, you're going to get a lower yield on your investment. So government bonds are generally the lowest yield investment that you can make, but they're very, very safe. So in a time of uncertainty, then it's a good place to park your money, generally speaking. Corporations, they can issue lots of different types of bonds, but the two, most common ones you'll probably hear are security bonds. These are backed by, corporate assets, or mortgage bonds. These are backed by mortgages like on their books. So, if you were to default on the loan, the bondholder could sell those assets because these bonds are backed by these certain assets or mortgages. I think that is it. So let me just end by saying, you know, let me know if you like this video, like, subscribe if you appreciate the content. If you learned something, I would love to, you know, hear any comments that you have. And if you have any questions about it, let me know. If you'd like me to do any different types of videos, let me know. I'm just getting started, but I'm really looking forward to creating some more content. So let me know what interests you guys and I will make it happen. Hope you guys have a great day. Keep it super simple and I'll catch you guys later. See ya.